Hi, my name is Colin Scarola, Vice President of Equity Research at CFRA. Thank you for joining me today as I'd like to talk a little bit about CFRA's strong and positive outlook for some U.S. airline stocks. So I'm going to show you the recent performance of the U.S. airline stocks in aggregate here, just so you get a little flavor of how they've been doing relative to the broader market. So on the orange line, we see the S&P Composite 1500 is up about 20% since the end of 2019, while the airlines are down roughly 50%. So they've obviously been hammered since the beginning of the pandemic. So you may be wondering, why does CFRA like the airline space right now? Well, one reason is part of the price pressure on airlines this year has been related to the large spike in oil prices, as I'm sure many of you know. But you may be somewhat surprised to hear that this has happened to airlines before, and their earnings have actually held up quite well and continue to grow. So on this chart, we are showing in the blue bars the price per barrel of oil during the 2010 to 2013 period. And as you can see, in 2011, we saw a large spike up to frequently over $100 per barrel. And it stayed very elevated, often over $100 per barrel, well into 2013. Now, during that period, conventional wisdom may have told you this was a terrible environment for airlines. But if we look at this EPS progression on the chart on the right, we show Delta, Southwest, Alaska, all during that same period when oil spiked up and remained elevated. Earnings per share grew annually between 15% and 22%. So excellent earnings growth despite that high oil price environment. That's a bit of historical context, so you don't have any preconceived negative notions about airlines right now with high oil prices. Now let's also think about what we just heard from airlines in the past month or so. Here we have a table showing the Q2 guidance updates that airlines provided during May and June. Again, you may have guessed that they lowered their revenue guidance and said profits were going to be down because of the high inflation and the big oil price spike. In fact, they did the opposite. They told us revenue was going to be much stronger than they had initially anticipated for Q2, and profit margins would be generally around 10%. Actually, around 11%, much higher than they had previously forecast earlier in 2022. So here's a couple of reasons that we think airlines are still seeing this really strong demand despite high prices. One thing is we've got 3.6% unemployment, very strong job growth. So every time you get a new job into the economy, at the median, that's bringing about $60,000 of income into a U.S. household. That's money that can now be spent on things like events and travel. It's just a good way to combat inflation is for another person in the household to get a job, and there's plenty of jobs right now with record U.S. job openings. Also, in this chart on the orange line, we're showing that U.S. household bank savings have grown about fourfold since the start of the pandemic. The typical U.S. household had about $8,000 in bank savings at the end of 2019. As of Q1 2022, that was up to $33,000. So there's a huge backstop of sort of pandemic era savings that can sustain a high demand for air travel. A third factor here is we're now starting to see a pullback on durable goods spending amongst U.S. households. A big reason for that is during the first 2 years of the pandemic, people stayed home a lot. They spent a lot on things like appliances, TVs, sometimes cars. And now the average U.S. household has about $16,000 more durable goods value in their home. So now that the economy is reopened again, people aren't worried about COVID and can travel. They're starting to pull back a little bit on that spending and put it more towards air travel. And so, well, we see these three factors, strong employment growth, very strong savings, up fourfold since before the pandemic, and sort of a shift away from durable goods spending. Those should be driving the top line for airlines for the rest of the year. But you've also probably heard about these staffing shortages. Well, you may be surprised to know that according to Federal Reserve economic data, uh, employment in the U.S. air transportation industry is actually up 8% versus pre-pandemic. So what that tells us is a lot of these staffing issues that we've been hearing about, they're not necessarily long-term structural problems, but more likely it's probably this surge of COVID-19 causing a lot of absenteeism. People are generally not getting as sick as they were from COVID earlier in the pandemic, but they're still often staying home from work. But we think this is a short-term problem. We think the workforce is there. We just have to get through this current COVID wave, and the absenteeism will start to go down and help airline operations significantly. But we really want to emphasize that that's more of a short-term problem and not the long-term staffing issue that you're probably hearing a lot more about. So all of this leads us to conclude that there are very attractive opportunities in airline stocks. It's certainly a challenging environment with everything that's going on, but when you see some of these percentage price drops in airline stocks of 40, 50, 60% relative to pre-pandemic level, even though their revenues are now higher and their profit margins are at healthy levels again, that tells you the selling's probably been overdone and there's some good opportunities. So among CFRA's strong buys are Alaska, Delta, Southwest, and United, and we have a buy rating as well on Allegiant. So those are our top picks in airlines. We hope you enjoyed our presentation. Thank you for joining us.